Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial planner. Today, I want to take you through what a retirement plan looks like with a client. While I cannot provide an entire picture, I can show you how we approach the process once we've had significant conversations with you. In just a moment, you'll see a mock client, and then I'll discuss how we approach their retirement or financial independence strategy. We will dig into their savings, goals, and the impacts of all those decisions. But again, it's not the entire process. In fact, this part of the plan is the hardest to show you. Instead, it gives you a look at how the presentation goes when addressing retirement or financial independence planning and what you can expect to see from the process. Not shown is all the steps and conversations we have with you before the plan is adopted and managed. Whatever you decide, it's a conversation with you, the client. Nothing is done without that buy in. Let's begin. So, as we run through an example, first we need to figure out who we are helping because so much of the advice is going to depend on the individual or family group. And so, for this example, I've just created a typical person who may come through the door. So, you have someone who's 45 and they're a private practice therapist. They are married to someone who is 43, and that person works for an organization, and they have two children. One is 13 and one is 8. And so from there, we would take a look at the income coming in. And so the spouse who works for an employee makes $80,000 a year, and the person who's runs the private practice makes about $150,000 a year. They currently spend about $8,000 a month. In terms of savings, they have the private practice therapist has a solo 401k that they put about $2,000 in. The spouse puts about 10%. They have a pretty traditional match of up to 3%, and then they put $3,000 into an IRA. And then you also have some 529 savings. They contribute $1,000 to each child's college education. Now for their goals, they want to retire by 67. They want retirement expenses to stay at their current levels, inflationarily adjusted for inflation. We've added health costs, long-term care costs. They also have, they would like to pay for at least some of the child's education, and the private practice practitioner, has been doing pretty well, wants to get a $50,000 car in the next year or so, and then they go on a family vacation of about $3,000 per year. The only other thing is in the net worth, we would include any bank accounts, joint and personal, any credit card debt, any other debts, the investments, as well as any loans that are out, whether it's a mortgage, another business loan, maybe the current price of property, and any other sources of income. When we were going through the probability of success with a client of the current or the proposed plan, one thing we are looking at is not only are we reaching all the short-term goals that we have, whether it's a spending goal, whether it's a purchase, or another sort of lifetime benchmark that they want to reach, funding college for kids and whatnot. But we're also looking to see whether they will have enough money to live on throughout the rest of their life. And that's really where this number comes from. And so, when we initially started, it was about 30, somewhere between 30 and 40%. Now we're up to 93%. And when we look at retirement, that's really what we're looking at. We're looking at whether or not this plan will help the money last for the rest of the person's life. Like whether it's you're looking at retirement or you want to work until you're 90, but you want financial independence. Essentially, that's what we're trying to determine. Would this plan be successful? And going through whether the plan is going to be successful from a retirement or financial independence standpoint is really the bulk of sort of the conversation and the back and forth and what they can do, what the client can do, and what the impact of those decisions will have long term. And part of that is really figuring out the values of the person, the individual person, as and mixing that with the strategies available. And so we would be going down, and this is really where that conversation takes place. So, this forum would be this side of the forum would be, sort of what they're doing now, like how they are attacking things now, and then this forum would be sort of the proposal, what they could be doing to increase the probability of success. And so this is a conversation. So if they're currently expecting to retire at 67, you know, right now we have proposed 67 for both of them. But what if one of them wants to work till they're 70? Well, we can adjust that. You know what? That's going to just increase the likelihood of the probability of success. I think it jumps to 96% if, say the private practice therapist wants to work till they're 70. Let's see. We also have some, spending expectations. So they currently spend about $8,000 a month now, adjusted for inflation. What if they want to keep that same spending mark once they're in retirement, adjusted for inflation? And we'll see the impact of that. The children's college goal funding all of it versus funding some of it. A new car, 50,000. Well, what's the impact of 40,000? And is that something that they're able to consider? If someone comes to me and says, I absolutely have this dream car, there's no ifs, ands, or buts, we're going to figure out sort of what that means, how they can afford it, but also the impact on the rest of their life, because these things don't necessarily live in a vacuum. So maybe they're okay spending $200,000 on a car if it means they have to work for 3 more years. It's not something I would necessarily do, but it's not about me; it's about the client and the person. In the office. And so if that's something that they're willing to do, I'm going to show them the impact of that. And so in this case, what's the annual vacation? It's currently 3,000. In the proposal, it's what if we do it 2,000? As things change, we can adjust this plan. So if more money comes in, maybe the annual vacation number creeps up. And then here are some tactics to help achieve that plan, and why the 40 to or 50 to 40 on the car and the 3,000 to 2,000 on the vacation, really you see the impact, because instead of saving 2,000, they're maxing out their savings on the private practice 401k. And they're increasing the rate from the spouse's 401k, and they're keeping the 529 about the same. And then we've incorporated some other sort of assumptions. So instead of a balanced investment portfolio, now it's a growth portfolio, and I'll show you the Social Security impact as well as their full retirement age based on that, and whatnot. And so this incorporates all the other back end sort of planning stuff that we will talk about either in another video, or we would talk about directly with the client. And so the savings plan, instead of, I think they were saving about $4,000 a year. Now they're saving about $47,000 a year. The total savings through the life of the plan is $1,219,000, which is an average savings rate of 18%. And, that's based on income, through the life of the rest of their working life of almost $6.7 million. So 18%, that's a very strong savings rate in this case. And the plan is based on certain assumptions. So it's based on certain assumptions for inflation, 2.5% inflation over time. It's assumed there's assumptions on the return rates of the investment portfolio. These are discussions we have with you prior to running the plan. We're not going to just put in 2.5% and say, you're comfortable with that, whether you're comfortable with that or not. Instead, we would discuss what the expectations are and why we have that number and whatnot. And so that's going to really get into this stress test. And so this really looks at what's the likelihood of this plan succeeding. And you can see the baseline is 93%. If the market drops immediately after you retire or after they retire, you can see it's still holding very strong. The one concern would be inflation. And part of the reason for that concern is because they're not decreasing their spending in any way, and they don't have other strategies in terms of how they're investing and didn't go through that full process. But it is something we would consider. When I see a 60% number, I would say I would be digging a little deeper into that. Why are all these so high, but that's so low? And figure out sort of a solution for that. And then we would also be looking at the Social Security strategy. So maybe they originally thought they would take Social Security at 67, but from what we can tell, the optimal way to deal with Social Security would be to use savings withdrawals from 67 to 70, and then let the Social Security get that most amount possible from Social Security starting at 70 and moving forward. And you can see they make almost $500,000 more through that strategy. And so it's something we would definitely be considering. And from there, we would then be looking at Medicaid coverage and other things. And this really depends on the person coming in. Someone in their mid 40s, they might not need to really consider Medicare yet and what their plan for Medicare is. They might not need to see exactly what the withdrawal is going to be once they are in retirement, exactly what those numbers are going to look like. Meanwhile, someone coming in at 60, we're going to be very focused on the Medicare coverage. We're going to be very focused on exactly what the withdrawals look like and when those withdrawals come out and what's the backstops for those withdrawals. And that's really just the difference in the individual client. And really, when it comes to showing a plan, one of the ones that's going to vary the most dramatically is the retirement section of the plan, because so many small decisions today are going to have very big impacts later on. But also, depending on your age, depending on where you are in your career, it's going to vary dramatically based on what you need.